Well, welcome everyone. There's nothing quite like a small security alert to get the session going. So this is US opportunities from an overseas perspective. My name's Stefan Dunatov. I've been asked to moderate this by Milken, so thank you, Milken, for asking me to do so. Briefly about myself, I'm currently the Chief Investment Officer at Cole Pensions, a £20 billion pension fund in the UK. I'm also an advisor at the Investment Committee of the Wellcome Trust, which is a £20 billion medical endowment. And I'm the chair of the 300 Club, which is a group of European and North American asset owner and asset manager CIOs who try to raise issues that they'd like to discuss and change in investment markets and the investment ecosystem. But that's enough about me, because actually we've got four excellent people here to discuss the topic. And what we'll do is we'll try to make this as much of a conversation, as a discussion as possible, and I'll just be facilitating really by asking a couple of questions along the way. To my immediate left is Xiaoliang Zhao from the China Investment Corporation. On his left is Sophia Cheng from the Cathay Financial Holdings in Taipei. To her left, Juan Manuel Valle Pereña from Afore, Banorte in Mexico, and on my far left, Lisa Gray. I'll ask
too easy, right?
Too easy. But what I'll do is I'll ask each of them just to say a little bit about themselves and give away any details they'd like to give away about their respective funds, and then we can kick off the discussion. So,
sure. Should I start?
Yes, absolutely, sure.
Great. My name is Xiaoliang Zhao. I'm head of the fixed income and absolute return department of CIC. Actually, CIC established in 2007, just before the financial crisis. So this is our 10th anniversary. It's a very important milestone for us. We do feel that we learned a lot of lessons by investing globally during the past 10 years. CIC International, the sovereign wealth fund part, most people know about us, managing about just over 200 billion assets. I think we talk about U.S. opportunity. We do believe U.S. is the most developed market, so we are significantly exposed to U.S. Aggregately, I think we are about just south of the 50%, half of our assets are invested in the States. So about 100 billion invested in the States, mostly through the public market, but we do have the real estate investment and some PE investment in the States.
Right, thank you. Sophia.
Hi, I'm Sophia Cheng from Cathay Financial Holdings. My group is the largest financial holding company in Taiwan, and the total assets about 250 billion US dollar. Around 60%, so it's 160 billion, is Cathay Life, the life funds. And we also run one of the largest private bank, second largest P&C insurance, largest asset manager, and a small venture capital and small broker. In Taiwan, 1 of 2 population is our customers. So the company care about sustainability, our impact to society, and we take approach for product and investment very long term. Today, out of the life's 160 billion asset, we have 60% in fixed income, roughly 15% in equity, and we also have about 12-13% in mortgage loans in Taiwan. And our fixed income, we have 53% total asset in overseas. Out of that, about 44-45% in US, 20% in Europe, and 20% in Asia Pacific. So combining fixed income and equity that we have in US, it's more than 20% of our life asset, and that therefore US matters to us.
Thank you.
Thank you.
Juan Manuel?
Yes, well, I'm the CEO of the largest pension fund administrator in Mexico. There was a reform 20 years ago that created a defined contribution scheme. Afore Banorte is the largest, almost 9.5 million workers. We administer their resources and we keep the bookkeeping, plus the bookkeeping of 8 million more workers. We invest approximately $40 billion US dollars. We are allowed to invest 20% of those resources abroad. As of today, what we have in the US is mostly debt issued by Mexican firms in the US markets. We are preparing to enter the US through mandate. We move more towards active management. We have done successfully in Europe and in Asia last year 1 billion and 1 billion through the most important asset managers in the world. And the intention is within the next 6 months to participate through a mandate also in the US market.
Thank you, and Lisa.
Thank you. Lisa Graham, the CEO of Victorian Funds Management Corporation. We're the asset manager for the state of Victoria in Australia, and is one of the fastest growing state in Victoria, down in the south, if you don't know us. We have approximately 55 billion assets under management, and our 5 major clients are predominantly pension funds and public liability insurers, so work covers, transport accidents. So many of our clients therefore have very long tail liabilities, which we need to be very conscious of. We manage about 1/3 of our money internally. We run a broad strategic asset allocation across all asset classes, and about 55% of that is in equities. And across our whole portfolio, about 15% of our various assets are in the US, be it infrastructure, property, equities, direct lending.
Thank you. So Sophia, could I start with you if I may? There's a lot of talk about a low return world, about asset valuations being high, etc., and often that talk focuses on the US, particularly US equity market. But from your perspective, what are the specific asset classes in the US that you think are over or undervalued? Or how do you approach the valuation question in the US?
Oh, that's a very tough question. Theoretically, 85% of our liability are Taiwan dollar. But today, the 10-year government bond yield is only 1%. And we had some legacy book in the very old days in the 1980s. We guarantee our life clients at 60% yield. So in about 1998, when central banks started to cut the reserve, we have been learning more about overseas investment. But in the year 2000, the industry has only 4% invested overseas. Today, more than half. So it's like chasing someone you really like, but you don't ever get it because the interest rate keeps falling. And the government issuing bonds never fast enough. And you also have the physical discipline. So we were forced to learn. We spent about a decade to fix the negative spread problem. I'm very lucky because Taiwan dollar is relatively more stable than quite a few Asian currencies. We're able to manage that also through a lot of hedging efforts. Mm-hmm. Yeah, so you're asking me about the valuation. It's very hard to answer because I think it's all about relative, right? So people say buy low, sell high, but sometimes it's like buy high and sell higher. Or you have to get in super early. So we do quite a few efforts. Today, is the market expensive? I start to get more cautious. I've been quite uncomfortable with volatility. And whenever we push one more year further, we start to think about either the magnitude of the time when it starts to correct. The abundant liquidity is pushing valuation, but I start to feel uncomfortable that there is a lack of risk pricing discipline in the world. So I start to raise the issue. I think financial industry has a moral problem. We are paying depositor very low rate. We are favoring corporate super thin margin, and we are charging students a lot higher. We are keep getting market share for inflow of liquidity, and then we're forced to invest bonds or the fixed income at lower rates. These days, people are investing equity for the purpose of yields. They are buying equity like bonds, and they are trading bonds like equity. So that is a big concern. But overall, we think the macro is still okay though for another few quarters.
So the implication of that is that you think that the low policy rate environment and the low yield environment generally seems to be slightly distorting things. You say we have to be comfortable in a low return world or a high valuation world. Is that? I don't know, Lisa.
Yeah, I think the low return, low yields is certainly distorting things, but so is quantitative easing and other monetary policy effects that we see many of the central banks undertaking. We would definitely see most traditional asset classes such as equities and bonds as being fully valued in this market and in most markets, certainly developed markets.
But in terms of the US opportunity set, does that mean you favour one? I mean, just what I'm trying to eke out here is if everything's expensive, how do you approach the different opportunities in the States?
I think you look for where you get rewarded for risk.
Right.
And one of the areas that we think you get rewarded is in private credit, actually. So that's certainly in the US, an area of great interest for us, and where we have most of our private lending is in the US in private credit.
Juan Manuel, you looked as though you wanted to jump in there.
We do see, at least in stocks, a little bit overvalue versus other developed markets, with the expectation that all the reforms will happen. And if that doesn't happen, then certainly there will be an adjustment from our perspective.
Sure.
I just add a couple of points. I agree with my fellow panel and this here, but I want to point out actually the first important things that absolute return perspective, our expectation should be low. That means going forward 2, 3, 5 years, we should expect a low return environment. That not to us as the asset manager, also should to the senior management, to our board, understand to get the expectation right. And the reason why it's low, I think there's mostly because of the cash rate is low. And on the other,
so it's a policy rate problem.
It's policy rate is low, but the risk premium, different asset, some are high, but in normal, but most of the case actually is from historical perspective is in the normal range. So that means what's our alternative? Put in the cash or invest it. So we have to invest it at this stage, I believe.
And with this odd world of low absolute returns, but risk premiums looking normal, and this is an odd juxtaposition to have. From the US perspective, I can just bring you back to this point, is do you prefer any specific parts of the US market, one or the other, or do you...
Yeah, I think to answer that question, I'm just about to say that actually last year, in the middle of the last year, I think during our macro research, we do have a bias towards US. I think aggregate our position from all the outside active managers, we do have a bias towards US. We think the US is the first one get out of the deflation, solid growth, extremely low unemployment. Actually, this happened even before the election. But until fast forward to now, that we do think that, as Juan just mentioned, a lot of things already pricing in the U.S. market, and compared to the rest of the world, European is doing fine, and the emerging market is stabilized. We do feel that advantage of U.S. Our moving slightly biased toward U.S. USD has become neutralized, if not already turned to the other side.
Right.
I can add some point to that. What we have done is from when we start to invest overseas with U.S. Treasury, and then AAA, and then single A, and then to all investment grade. But at current moment, what we have done is, starting the past 3 years, we keep asking ourselves, when we think about insurance policy, we are offering very low 2% return. So the legacy problem is being averaged down. We think that's equally important than keep tracing better yields at the risk of liquidity, credit risk, and the others. So today we are still overweight US in terms of fixed income the most, because the rate is relatively better. And like Xiaoliang said, we do agree that the overall structure, and this is once in a decade, the whole world is recovering, except the valuation is there waiting for fundamental to catch up. So fundamental cannot miss it. And the other thing is, we'll try to think about if rates start to rise, then what do we want to avoid in the next rate?
Well, I was about to ask it, the different way to ask the question.
So one is liquidity risk. So for example, if I can get bullet bonds, I wouldn't try to get too much callable bond. Callable bond today is only 5% of our assets. And then non-investment grade is only about 6%. And because we have acquired Cunning Asset Management here in Hartford, Connecticut, so anything BBB or below, we will try to delegate more expertise. We also have about 10 to 20% of our asset is to external managers, so we can also have the exchange of ideas and trust the expertise from them. And then, so the non-investment grade is about 6%. And to mitigate the risk for overseas asset, that we will have to handle hedging. We try to make the life more focused. We have 93% of our bonds is denominated in US dollar regardless of issuer. We have about 4% from CNH, the renminbi. The other minor currency may be Australia or sterling, like 1%, which we all hedge against US. Right. So I can focus on taking deeper research into the corporate themselves, and we invest more than 200 investment research talents in Cathay Life. Also a big team in asset management. We have an internal macro research team, 15 economists directly under myself and then hates me. And then we have a dedicated hedging team, more than 20 people.
How do you get 15 economists to agree on anything? No, that's a separate question. Sorry. Can I just ask, can I take your comment about what to avoid and just see what others are avoiding? Because I think it's a different way to ask the question. So, Manuel.
Well, in our case, since the evolution of the investment regime for the pension system, that it's mandatory, has been slow. 20 years ago, there was no domestic savings in Mexico long term. In 20 years, we have 20% of GDP. The authority has been quite cautious. So we are allowed to invest outside 20% of our portfolio. And it has been not too fast, the process. From a purely diversification perspective, we should be very invested in the U.S., given the size of the economy, the financial markets, the instruments that we can find there. For different reasons, last year that we began with the mandates, we began with Europe and with Asia. And it has been complicated to enter. As of today, once we make the call, the main challenge is whether the expectations will hold after the reforms, because if they don't hold, probably we will still wait, because we don't want to be the ones entering at the highest point, even though it will end up higher. In the middle, we will have to give some explanations, and that's not the best idea when you're administering 10 million
so there's an
workers.
Valuation worry.
Yes,
and Lisa.
For us, Stefan, it's very much around public credit, high yield bonds. They're the sorts of things we're trying to keep at a much lower level. We just don't think the risk, on a risk adjusted basis, those returns are terrific interest. We think there are other opportunities, particularly, as I said before, in private credit. The valuations are too fully priced now for us. But we're still very much in equities in the US. We think it's a very strong, broad-based market. There's a lot of terrific leading high growth companies here, and it's a mature market in terms of expertise. So there's a lot of great shareholder focus, which continues to raise the performance, notwithstanding they're fairly fully priced.
I've noticed that in all the discussions so far, we've stuck to what I'd call the liquid asset classes. So Lisa, could I ask you to kick off perhaps on how do you assess? I think we've spoken up to now broadly about the valuation issues and relative risk pricing and so forth, but could we just delve a bit here into are you preferring more liquid or less liquid asset classes, and how do you see those different sorts of opportunities? We haven't mentioned, for instance, private equity at all here either. No, so how do you assess the liquidity side?
Yeah, so certainly we think there's plenty of options from a liquid listed perspective in the US, and I particularly would cite equities. And so we have about 53% of our total international equity exposure is US based, and even a lot of our Australian equity exposure, about 10% of that is US generated revenue. So that on the liquid side, that continues to be of interest to us. On the illiquid side, we would love to do more on the infrastructure side of things. But that will require reforms to come through, potentially some tax reforms, as well as a good look at the infrastructure market here, potentially asset recycling, using more private public partnerships, etc., to really open that up, potentially hopefully sales of airports, etc. So at the moment our infrastructure US portfolio is 2/3 energy.
So an infrastructure program in the States would be really helpful from your perspective?
Very helpful, yeah. But it's the sort of thing you have to watch and to see how reforms occur. And I know even at this conference, the Australian ambassador, the Honourable Zhao Hockey, is actually talking about infrastructure and sharing a range of things that Australia is doing as well. On the illiquid side, we have great interest there, and it's not so much in private equity. It's not an asset class we are actually participating in. We've been exiting private equity, nothing to do with the US. Right. It's just part of our own, largely around some elements of illiquidity, but predominantly around reputation and the whole operating model of traditionally of the private equity space. But we're very interested in private credit, direct lending. We continue. I mean, we've been strong participants in distress lending. There are still some opportunities in the US, but our particular focus is very much on the spreads you can now get through the illiquidity elements around private credit, direct lending. It's complex, so there's less players able to participate in the marketplace. So you can get better prices out of that, and you actually need to be quite active. And again, that's a different skill set, but you get rewarded for that.
Xiaoliang?
Yeah, I think very similar to Lisa. I think just be more precise. I think on the allocation perspective, we are more moved to a barbell approach. Just as Lisa explained, one side we are moving to more focus on more investing in more alternatives, including PE, private credit, and the real estate. We think there's a liquidity premium. As a long-term investor, we know we should be able to harbor that. On the other hand, we do believe that by finding good managers and also find good asset, hold good asset, can enhance our return. On the other side, we are moving to more passive and liquid assets. So that gives us some potential liquidity, and when we need money, we can get it from. But that is a very slow process. It doesn't mean we are moving 50%, we can do it in one day, just a direction of that. One more thing, I also just echo what Lisa just said. We are very much interested in the direct investment in the US. I think early this morning, Mr. Mushi mentioned that other than the CFIX, it should be very easy. But from our experience, it's hard. It's policies, regulation, and it's hard for us to invest directly in the States. So we have been focused on some European countries, Australia, and other emerging countries. But going forward, I think right now present opportunity, as Lisa mentioned, the new administration. We think policy may change, and without a good regulation environment, with the right structure, we do want to invest more in the States. Manufacturing sector, infrastructure, as Lisa just mentioned, I think there's some interesting fields. We definitely want to get involved and want to invest. That also on the right side.
And again, so going back to Lisa's comment, there's underlying policy issue here that sort of needs to be dealt with.
Definitely a lot of it. It's not that easy, as just Mushin said. It's not easy. We have to do a lot of policy. Regulation should be right. Policy environment should be friendly, and we have to structure right. Mentioned that the public-private partnership, we have to open mind on different structures to get us in the market.
Can I just ask one, Manuel, here, in terms of the context of your fund, which is slowly growing, and you're clearly a little cautious about the state. I mean, how do you see how do you deal with the liquidity question? Because that's another compounding problem, isn't it, from your perspective?
Yes, it's interesting regarding liquidity, because many of the instruments that are attractive for us, US-denominated instruments, both by Mexican companies, public and private, we prefer them to be traded in the US, because if we want to do anything a little bit more sophisticated than investing directly at the beginning, it is almost impossible for that to happen. The secondary markets for many instruments in Mexico are quite thin, and we do use the US market as an alternative because that's where we can get the liquidity. We have been working with the Mexican government in trying to make those instruments in Mexico more liquid, but without that, we do trade those instruments preferably in the US, because we have all the financial institutions in the US interested in those instruments and allowing us to do many things to provide liquidity. Besides that, I think it is hard that we do anything else. We look mostly for active management, and that's why the idea of the mandates. In the short term, it seems hard to imagine that we will be doing something differently. There have been a lot of opportunities in Mexico because of the reforms, both infrastructure and energy, and the resources we feel comfortable with what we have seen in Mexico. So it is hard to imagine that we will be engaged in those areas or projects in the U.S.
It's interesting that you start from the premise, though, that your local markets are liquid, so therefore you need to get liquidity elsewhere, which is sort of a different prism, I think, to some other investors in the room. Did you have any other?
For our assets in U.S., we haven't been buying U.S. Treasury for buy and hold for quite a long time. If we buy U.S. Treasury, tend to be taking a maybe 12 months view that we think rate may be fallen. And so most of our fixed income in U.S. is actually MBS, corporate credit, and financial debentures. So it requires a lot of deep research into those instruments. And for U.S. equity, that's easy. We got many great companies, very good liquidity. Even we buy size of both of my overseas equity in that, the liquidity is no problem. And because Taiwan makes a lot of things, all the iPhone you are using is assembled by a Taiwan corporate. So we got very good industry research, supply chain research. So if we think about what's going to be the future application, what's going to be good 2-3 years later, we can always get a little bit alpha from being early.
Right.
Yeah.
And from a liquidity perspective, are you stretching out like Lisa's doing in terms of the liquid credit, or are you looking?
There is some regulation constraint. For example, we can't buy overseas non-investment grade except for ourselves due to better risk management structure. We can buy some non-investment grade. And we really hope we can participate in like Southeast Asia infrastructure project. There's a big shortfall, but we cannot buy non-listed company and overseas a private company. And for the PE fund alternative investment, because the capital charge to the risk-based capital for life insurance as in Taiwan is quite high. So we do look at PE and hedge funds, but we get a bit selective. There are also regulation constraints on the history and AUM if it's a mandate instead of buying their fund.
Got it. So there's internal constraints on you being able to do that.
Right. But the government is opening that. So if you take every 2 years, they open a bit of things, which is quite positive.
Okay. Could I, Xiaoliang, now ask you, perhaps in the context of what's seen as a relatively germane policy topic, which is currencies. How do you, from your perspective, everyone here is an overseas investor when it comes to the US, so I think everyone here will have a slightly different view on this because people approach currencies and hedging and so forth using policies they've devised internally. But if you could start off here telling us how you think about US opportunities in the context of the dollar. Do you hedge, do you not hedge, and what's your approach to that?
Sure. I think my problem maybe is easier compared to the other guys. First of all, we are really long-term investor and we don't have a liability risk. We are very stable capital, so we can first of all, our asset is in USD. Our return is measured in USD, and we do have currency exposure. But we believe, because we are long-term investor, we believe in the long run, even though we take some currency risk, it should be neutral out. So just explains our situation. We have a reference portfolio. By default, our reference portfolio will lead us to implied reference currency basket. So we are not. That means we are not 100 USD exposed. We are not exposed to USD 100%. We do have exposure to other countries. And for our public market side, we do very much closely follow the benchmark. Our active management, either inside or outside managers, can take some active currency risk, but it's very limited. On the private side, the PM can decide whether he can hedge or do not hedge from private investments. But aggregate together, our risk team and the asset allocation team is constantly monitor the situation. If we are for each FX exposure is out of the boundary, they will do the overlay, bring it back.
That sounds to me like then that it allows you to focus really on just the underlying investment and not worry about the currency at all, is sort of what you're saying.
Yes.
Right.
Which
is helpful.
It's very easy.
Which is very helpful. I'm not so sure everyone else can say
we do
it.
think about, on the top level, we do think we have a big non-USD exposure, whether we should run an overlay program to generate alpha in long term, but we haven't found, it's hard, we understand that, so we haven't done so much on that front.
So
Sorry.
We run a pretty traditional hedging strategy. So with our fixed interest, absolute return type assets, they are fully hedged. So we take out any currency elements to that. With our equities portfolio though, it's 50% hedged. And so we have the wondrous opportunity of running things in the A dollar, and so that is positively correlated with international equities actually. So it gives by 50% hedging that then we're able to create some sort of buffer depending on what occurs in either direction. And we also do look at the Australian currency and will tilt in various directions depending on either our own currency factors and also broader macro interest rate inflation.
So if I could just try to line this up, this is currency I find fascinating problems, right? So we've got a pure long-term view over here from the US opportunity side, and you've described in the fixed income space what I call a classical view, which is you hedge out all your fixed income. What leads you to then hedge out exposure on what's ostensibly a long-term investment like equities?
Well, we only do 50% hedging on equities. Right. So and that's in large part because we are originating in the Australian dollar and the way that behaves and trends with particularly international equities with the US dollar, etc. So that's why we do 50%, just to give us more optionality.
Sophia?
Hedging is our headache, yes.
Hedging is a headache full stop.
It is, yes. When US rates start to go up, but Taiwan have too much liquidity, so the rate doesn't go up that much, and therefore the short-term rate spread is the pricing for the currency swap. And in the old days, we were doing a traditional swap, and then when rates start to move, we just got kidnapped by the foreign banks, abusing us with any price they want. So we spent more than 10 years learning about traditional hedging, NDF, and also the correlation of various Asian currencies. If Taiwan gets stronger, there are some currency that structurally is more volatile and even stronger than Taiwan. So through some basket hedge, in the past 5 years, we have managed our hedging costs as less than 1%. We're quite happy to see that. So as of today, I have 60% as overseas. Roughly 30% is my US dollar policy or Aussie dollar policy, which client give me the foreign currency, I pay them claim. So about 70% of that I need to hedge. So it depends on our expectation on currency volatility. We have a hedging team, more than 20 people, and the economist who hates me. Now we are a very close team. We keep thinking about the structural value, and some the hedging team can think of the tactical side. So we have roughly high 50 to high 60% range, which will be through traditional hedging, including currency swap and NDF. We have, as of now, 20-something% in AFS, which is equity. We already assume required return. When I buy Amazon, Google versus buy a company in China, we should be requiring different yields anyway. So the AFS is open. And then we have this basket hedges, a basket of the Korean won, Sing dollar, Australian dollar, Japanese yen. Those we're looking into correlation against Taiwan dollar, mean to offset if we get a currency wrong.
Right. And at what stage does the hedging policy or your hedging, either overall policy or how you implement it, affect how you see the US opportunity set? Does it ever change what you might invest in?
US is easier. The problem is Taiwan dollar, because Taiwan dollar is not recognized a global well-traded currency. So the difficulty is having to get a very long-term contract for hedging. So even if we say we hedged, actually it's hedged on ongoing basis. You have to keep roll over. So having a very strong effort on looking into the global, and I think if the currency itself too volatile, we try to avoid. So even if we buy an India bank's bond, it has to be denominated in US dollar.
There is some impact on what you might buy.
But the good thing is Taiwan currency, whenever the currency appreciates by 5%, the whole manufacturing industry complains. Because Apple Computer abused Taiwan supply chain, Taiwan supply chain will try to abuse central bank. You got to make sure currency is not too volatile. Right. I was thinking about like Korea should do more overseas asset, but they can't because the Korean one's far too volatile.
That's interesting.
Yeah.
Well, for us, although it is a headache as for everyone, we receive the resources in pesos. The pensions will be paid in pesos. Our strategy is quite similar. almost everything is hedged, and in equities like 50%. Given that we don't have equities as of today in the U.S., no, that's not the case with the U.S., but it will be the case. And it's interesting if we see the volatility within the system between the pension funds that do have this strategy because they are the ones that are more sophisticated and are allowed to do alternatives, and those that don't do alternatives, the volatility in the returns, we minimize that volatility for them. They could have a wonderful last year because of the devaluation of the peso, and a disastrous first quarter because of the revaluation of the peso. So for us, it is natural to do it because of the denominated liabilities, but also because we prefer to maintain not so high levels of volatility due to the exchange rate, because clearly the peso versus the dollar is quite volatile, not only because of the peso, because it is the natural currency for hedging, for example, almost versus all countries in Latin America, all currencies. So if you see the operation between the peso and the dollar, it is clearly far beyond what can be explained between investment and trade, and the explanation is the rest of the region.
Certainly for your perspective and also for leases, with it is effectively, I mean, you've spoken about the peso being used as I guess as a way to measure sentiment in, say, Central and South America, and there's a commodity currency element as well to this as well. I mean, how do you focus on, when it comes to assessing US opportunities? How do you focus on making the right underlying investment decision and keeping the currency out, or how much does the currency impact what might be an underlying investment decision in the US?
I mean, generally we focus on the fundamentals of the particular opportunity, and we will have a look if there's any particular currency elements we need to be concerned about. And then if we think, though, the fundamentals hold up, then we find a way to manage the risk around the currency. So the
currency is an implementation problem that comes second, right? And that sounds broadly right.
Yeah.
Could I then, Juan, just sticking with you, and you talk about the peso as being sort of a bit of a barometer, and in fairness, the recent political climate has been a bit of a test of that as well. So, from your perspective, could I ask, what are the signals or triggers that you're looking for to reassess your outlook for US assets? We've already hinted a bit at this, I think, in terms of some policy discussions that have come up. So, I mean, this could be economic, it could be political, but from the outside looking in, what would be a trigger to start to reassess what's going on in the US, either positively or negatively?
What I will say, what we see, what we are concerned, and what we want to see as the triggers.
Sure.
We clearly see the largest market, a natural diversification for our portfolio, strong economic data, and positive reviews on earnings. That's what it's quite obvious. What we are concerned about, a deception regarding the reforms, and we do see stress valuations in comparison with historic data, and in comparison with the evolution in many developed countries. In all of them, we have seen a revaluation process, but we've seen it faster in the US in the last year. What we expect to see, for not being concerned anymore, we do expect to see good quarterly reports, because that will support that this is for real, and we do expect to see a good delivery of the reforms. For us, particularly infrastructure, fiscal, and financial deregulation. But the two first, we believe, are the most important for allow those valuations to hold in the longer term. If we do want to see the US economy growing faster with more productivity, we do believe that fiscal reform and infrastructure are key. Obviously, trade is a very important one, for not only because of the expectations for many firms, but because of the relationship with Mexico, since we have one of the closest relationships between two countries in the world regarding how correlated our economies are. Whatever happens regarding trade will impact this correlation and will force us to reassess how we want to work with the US. In the extreme, maybe a less correlated economy will make it more interesting for us to invest in the US. although that clearly will be bad for trade. But thinking only in investment, if we are less correlated with the US, that will make more sense even for us to invest in the US, because as of today, so correlated and many firms moving back and forth, it is not so obvious what our gain would be. It would be more obvious with less correlation.
Xiaoliang, from a very long-term perspective, and almost as a dollar investor, as you were saying beforehand, how do you reassess? What's the triggers you're looking for assessment here?
I think I agree with what Juan just discussed. But I believe that it's really hard to predict what's triggered the crisis. Just like the 2008, nobody will be hardly. Majority of our industry did not predict that subprime will be cause a problem. Right now, we talk about this every day. We know U.S. policy, we know European situation, we know North Korean situation. But I think it's really hard to know what will cause the problem. I may be more focused on the market. I think we need to pay a lot of attention to the market, the liquidity situation, the crowded trades. I think as we discussed, we find out we are in the same boat in a lot of aspects, moving to a higher yield. Not only institutional investor but also retail investor rush to the crowded position, both on the asset class basis and also from active management basis. A lot of crowded names held by the institution investors. We know that last year when there's some fund has to liquidate, running the problem, and may cost market has been coming down very fast, very big. So I think it's in order to find out what will be trigger, you may be prepared. I think in this situation, volatility has been very low for many years. The guys short volatility has made a lot of money. They're already accustomed to that, make the short, make the carry on the volatility side. And the long vol guys has been, lost a lot of money, has almost thrown the white flag. I think you always have to keep that in mind, have to construct your portfolio with the long vol characteristic, either by some macro or CTA, or structure the long volatility trades, obviously with the concern of cost, build in the portfolio to be ready.
So keep focused on the investment decisions. Yeah, that's what you're saying.
It's hard to get
don't be too cute on anything else.
I know well.
Yeah.
Go ahead,
Sophia.
I studied meteorology in college before I moved to financial industry study. And forecasting weather is the same as financial market. Very often you don't get it right. And every day I think the market is my teacher. At the end of the day, I think macro is considered a major industry. So we put a lot of effort on looking into the key parameters. And we have been doing a project more than 6 months now on US and Europe everywhere. What are the major 80 factors we should look at as a pre-warning? And then we scan down to, and I hate the multi-dimensional regression, because every time is different. So we have to identify when what's happening, we should be cautious. For example, the recent job creation in US is a bit low, right? But you can notice it's the government reducing, but the private sector is hiring, and they're hiring more full-time jobs. And you can see US household savings at 20 years high at this moment, so they may probably start to afford spending. But bear in mind, don't be too over bullish, because you got dressed weather every spring. You have to finalize that whether you need the money to fix house. Mm-hmm. So I think there's a lot of moving parts we have to work on. So the industry trend, the underlying utilization now already to trigger capex is happening. US tech policy, infrastructure, how corporate are guiding a lot of the CEOs, what they are talking. You can easily get a script from Bloomberg. So just get deep into what they say. Do they talk the talk? Do they walk the walk? That's very important. And then the government debt. Because when you think China's currency a bit weaker and Japanese yen already depreciated to a level, whether they will be the same size of amount buying into U.S. Treasury, and they're definitely the new supply demand for U.S. bond could have some impact on interest rate. The high interconnectability among different financial markets. So I can look at U.S. only. I have to think about whether how Euro recovery. It can be flat, but as long as it's improving, that's good. And what's more bigger problem than central bank balance sheet is the emerging market debt. In 2004, they were only a couple billion US dollars. They are now more than 20 billion US. And the credit spread is far too thin, right? So you got once in a decade recovery, are we going to get once a decade correction? So these are all very important factors.
Lisa, anything to add?
To add is similar. We're long-term investors, so whether things head up or down at some level, it's such an important market. It's terrific for diversification perspective, so we will continue to ride that through. For us, adding more will particularly be around the tax reforms, what happens with infrastructure. That's where we're particularly interested, because we see there will be terrific opportunity. But I think if you listen to a lot of the discussions in the plenary sessions today, it's all about how well are they going to be able to execute and over what time frame.
There's clearly a lot of policy risk.
Yeah.
Just before I open it up to questions, because we're approaching the end of the session, you mentioned, Sophia, at the start about responsible investing, I think it was. So just very quickly, does anyone have a comment about whether how they see responsible investing in the context of the US opportunity set, and if you have any priorities for responsible investing, are there opportunities in the US that allow you to tick both boxes, to have a US investment, which is great, but also be able to say, I've actually ticked a sustainable investing box? I know the Australian investment houses are a bit more up to scratch as well on the things like PRI and that. So who wants to lead on that? Sophia, you made a comment.
Maybe I can. We learned a lot from Australia. It's great. They care about sustainability and the responsible investing a lot. In Taiwan, it's quite early stage, and I am trying to push as much as we can. And I think in US, I quite like the World Bank talk on how we can actually do some investment and helping society. But I think responsible investment, it also includes responsible lending. And if we keep pushing the rate and spread those things, automatically you will be shifting your risk appetite toward the safety part of the spectrum for bank book. Then you totally lose a function of a bank who is supposed to nurture SME into future great company. So I will hope to encourage banks to have better risk pricing discipline. So you should be charging the proper corporate at the proper yields. Therefore, we can use that to facilitate more meaningful project. And the Wellcome conference this year having a meaningful life. For investment, I think if I can willing to give us a market share and focus on making the longer term policies rather than keep getting market share and go for riskier assets. That's one way of fulfilling the responsible investing. So at the end of it, I think it's very simple. It's responsible ABC, responsible allocation of your asset, responsible business, and then responsible communication. We should communicate with our stakeholder. The beauty of having things more sustainable than just the superficial accounting number and the market share.
Lisa, from the Australian perspective?
We're very actively involved in UNPRI's signatories across all of our asset classes, and with every manager, as we do due diligence, ongoing or new, we ensure that they are too. So it is a key part. We're very involved in a range of discussions. Having said that, it's integrated into our investment decisioning to varying degrees, and we need to enhance that further, and over time I think shift to where you become much more engaged and more of a steward around that, and there are only a few areas where we cannot invest.
Okay, and there's nothing limiting in terms of the sustainable investing side from the US perspective. Are there any questions at this stage? Is two. So can I just ask that we take both questions and then we'll answer them? If you could just pass the mic straight over. And
sure. I was wondering for the panel, what do you view as an appropriate, alpha for your investments? And that can either be expressed in terms of net spread above your cost of liabilities, or what you think is the appropriate amount of alpha that can be generated in the current environment from a total return perspective.
Right, and could we just ask the next question straight away as well, and we can try to wrap them up at the same time?
Yeah, I was wondering, as the world gets more interconnected, is it actually much more challenging to get unique U.S. exposure? So for instance, if you invest in Apple, are you really getting exposure to the U.S. or is really exposure to the globe? And how do you guys think about that?
That's a good question. Appropriate alpha levels and unique exposures. Who wants to tackle them?
I'll start. So I think you mentioned your reference portfolio, I think, based. We are very much benchmark driven and very alpha oriented, and the reward of the team is very linked to that, both shorter and longer term. Shorter term, we typically look for at least 100 basis points above the relevant benchmarks. Longer term, it'd be closer to 100 to 200 basis points. Yeah.
I think that's really hard. I think there's so much money pounding into the active management. I think the result of active management, especially on the public market last year and the year before, has been disappointing, including hedge fund. So I think, as I mentioned, we have been moving toward the passive and liquid investments. I think to generate 100% alpha.
So pick a number. Was it 50 bips?
I think so. That's where
it could be as low as 50. Yeah.
I think so. If we get all our, public asset, public market investment, 50% alpha, we're extremely happy.
Yeah. With apologies to the active managers in the room for that one.
For example, for us that have been working last year, Europe and Asia, we went 150 basis points, and part of the complicated discussion within the US, it's how much we can expect to get, and then the trade-off, because ETFs are very cheap. Mm-hmm. So the management costs plus what we expect to gain has been part of the toughest element in the discussion, because we were thinking of 100 basis points, and part of the discussion was if that was something feasible or not, and then if it was not feasible, then if it made sense to look after an active strategy or better go through ETFs.
And of course, in a low return world, there's even much more pressure on costs. So you end up with, I think, this barbell strategy that you were talking about before, of sort of passive here and quite esoteric alpha over here.
We benchmark insurance liability reserve. For example, today, we need to make about low 3% as a yield. That's already quite sufficient. And as the new product we're offering at low 2%, and we also try to sell as much investment link as possible, because we can engage with our own asset management, other excellent teams. So.
And on the unique exposure question, I mean, how do you see Apple versus? I mean, how do you do this?
Yeah, I agree with. I think it's hard. It's getting harder. If you look at, we have a heated map, the correlation between the different countries, different assets, especially for the last couple of years, has been getting darker and darker. So it's a correlation. Correlation has been really high among different assets, among different regions. But we see sign of the divergence. I think recently, as the U.S. the first one pull out the interest rate cycle, I think they potentially, and the EM has been different country has doing differently in the different phase. We see some encouraging side that they maybe potentially has we have different source of return. Of course, right now U.S. still dominated driving the market as a whole.
Juan, you wanted those?
Yes, when I was talking about the perspective or the risks regarding Mexico, and I mentioned trade, I mentioned it particularly in the relationship with Mexico. But clearly, anything that affects trade, given that approach, it has to be a sensible element in the discussion, because it's not only the expectation of whether that will be beneficial for the U.S. economy, but in the shorter term, it will clearly have an impact because of the way the income and the revenues of most of the largest companies is distributed between the different markets, and that clearly can hit almost any company.
Yes, I think. Sorry, Lisa.
Well, just another dimension to it, actually, because this interconnectivity and the relationship starts to play out everywhere in very complex ways, be it around different trades, currencies, countries, etc. But it's also around a whole range of other factors and risk factors, particularly. And so, one of the things we're doing is really trying to invest a lot more in our portfolio and data and analytics capability and different tools to start to see this in a real sense and in a very dynamic sense as well.
I think. Do you want to last word on that?
I do think U.S. market still have its unique position though, because whenever there's a crisis, by default you are forced to buy U.S. Unless one day U.S. debt gets super high level and central bank become totally powerless. And U.S. has great company with innovation. And I do appreciate a country where you can find decent amount of good corporate governance companies. But yes, global investment is important. We used to be invest so probably more than 80% in overseas equity, but today we have about 34% in Asia, like Asia, Hong Kong, and eventually I think emerging Asia will be the market that people look for. By 2050, they will account for half of the world GDP if you do PPP adjustment. Yeah, so I fully agree there's pressure, but I do think U.S. does earn some respect from creating a very good environment for innovation. Yeah.
I agree. And it's interesting that all the risks we've spoken about, the risks tend to be policy-driven and trade-driven risks, and those are quite US-centric risks. So although you get this, although the corporate problem is global, the policy risks are certainly local. Well, look, Sophia, Lisa, Xiaoliang, and Juan Manuel, thank you very much. Unless there's any other questions, I think there is one sneaked in at the very end. You've got exactly 1.5 minutes.
Thank you. So it sounds like everybody on the panel is generally bullish about the U.S. I'm wondering for each of you what might be one primary potential catalyst that could change your outlook on the U.S., whether it's a potential geopolitical conflict or a fundamental change in the U.S. economy, or maybe a change in trade or currency policy.
Well, I can start. That's
60 seconds.
30 seconds. Science. So I humbly monitor all the potential parameters because this is already into a party. You don't know when people will turn off the lights. And I want to try to let go a little bit of final part. So learn to be early, but at the meantime being humble. So every day, starting about late 2015, we keep asking when will it stop. So I tell my team, put on the seatbelt, and you will experience the biggest volatility in your career for these young people.
I'm going to use my moderator's prerogative and let Sophia be the last word. So thank you very much again.